This is the third video relating to accounting procedures, rules of debit and credit. Now, in our book T.S. Grewal, in the sixth chapter, the author has discussed about the rules of debit and credit using the traditional as well as the modern approach. We have discussed the traditional approach. Now we have taken chapter 8. Chapter 6 and chapter 8 we are discussing together. We are using the rules of debit and credit explained in chapter 6 in chapter 8 under using certain transactions, specific transactions in this video, third video of accounting procedures, rules and debit, rules of debit and credit. So that's why I have written chapter 6 oblique chapter 8. Already we have discussed the journal entries and all. So here in this video we are discussing accounting procedures, rules of debit and credit and journal. Okay, here we are taking some specific transactions. First one, bad debts. Now see, the firm deals with some of its customers on credit, and when the firm is selling or the enterprise is selling goods on credit, the customers are known as debtors. Debtors are the people to whom goods have been sold on credit. Sometimes some of the debtors are not in a position to repay their debts. Okay, so the amount become irrecoverable. Such irrecoverable full amount or partial amount is known as bad debts. Okay, it is a loss to the business. Therefore, it is debited to bad debts account and credited to the debtor's personal account. Okay, bad debts account debit to debtor's account. Okay, because it's a loss, so bad debts will be debited, and debtors being current asset personal account, okay, will be credited. Bad debts recovered. If the debtors whose account has been written off as bad debts pays the amount partially, that means in the first point which we discussed, we have recorded it as bad debts. We have credited the debtors account and closed. Earlier it was having a debit balance. Okay, debtors personal account are debited when credit sale is there, and when the amount becomes bad debts, it is irrecoverable. To close their account, we credit them. So the personal account is no longer existing in our books. So when that person is paying the amount which was written off as bad, will be considered as a gain to the business, and it will be credited to a newly opened account, new account, that is cash account, and bank account will be debited because cash is coming in, and bad debts recovered will be credited because it is a gain. Okay, just compare both the entries. Losses are debited, gains and incomes are credited. Goods given as charity. If cash is given as charity, then charity is a loss, donation is a loss, so charity account debit to cash or donation account debit to cash. Okay, but when goods are given, it is not considered as a sale. Okay, and the charity or donation will reduce the purchases. Okay, purchases will be reduced by the cost of the goods donated or given as charity. So charity account debit or donation account debit to purchases. See, most of the time purchases we have debited, but there are few transactions in which purchases will be credited, and this is one. When goods are given as charity, purchases has to be reduced by the cost of the goods donated or given as charity. So purchases will be credited by the cost of the goods donated. Goods given as free sample. Now when goods are given as free sample, it is not a sale, it is advertisement or sales promotion, which is a expense, and expenses are to be debited. So free sample account debit or advertisement account debit to purchases, the cost at which the goods donated were purchased. Okay, so advertisement account to purchases. Second entry where purchases is credited. Third, when goods are stolen or goods are lost by fire. Okay, due to some fire the goods are destroyed, damaged, so it is a loss to the business. So loss by fire or loss by theft account will be debited and purchases will be credited, because purchases has the goods have been damaged or destroyed, or we have lost that, it's a loss, so it will be debited, loss by theft, and purchases we have to reduce, so it will be credited. Goods withdrawn by proprietor for personal use. Okay, now when goods are withdrawn, a drawing account will be debited. If capital is introduced, amount is introduced, capital is credited, and amount, if it is withdrawn for personal use, drawing account will be debited. So drawing account debit to purchases account. Okay, at the cost price, the cost of the goods withdrawn by the owner. Expenditure on installation of fixed assets, like machinery, when it is purchased we debit machinery account. When transportation is there, we debit transportation charges account debit. Okay, but when machinery is purchased and to bring that machine to the factory premises, whatever transportation charges are paid, to install that, whatever installation wages is paid, all this will be treated as capital expenditure. It will not be treated as a revenue expenditure. So when installation charges, transportation charges are treated as capital expenditure, it will be debited to the fixed asset account. Say if machinery is transported, machinery is installed, so machine account will be debited. Okay, see what it is written: expenditure incurred on carriage, installation of machinery are treated as capital expenditure and debited to machinery account. In the same manner, if building construction is taking place and whatever expenses have been incurred to acquire the raw material like cement, sand, steel, bricks, okay, doors, electricity, electrical equipments, everything will be debited to the building account, or everything will be treated as capital expenditure, therefore building account will be debited. Entry will be machinery account or building account debit to cash, to bank, or if it is a credit then vendor's personal account.